It is no secret, at least to listeners of this channel, that REITs have been the worst performing sector in the S&P 500 over the past 18 plus months. It is a sector that is very interest rate sensitive, and with rates extremely high, the sector has not performed quite well. However, what is on the horizon? Interest rate cuts, and this sector is gearing up to roar higher. Investing in REITs is yet another way to add real estate exposure to your portfolio. And after all, diversification is key to building long-term wealth. And in today's video, we're going to take a look at 3 high-quality REITs trading at very cheap valuations. All 3 of these REITs have huge upside over the long term. After all, the name of the game is to buy low and sell high. But before we take a look at each of these 3 REITs, do me a huge favor and let YouTube and the algorithm know that you enjoy the content by hitting that like button down below. Subscribe to the channel and let's jump into it. Hey everyone, Mark Roussin here, back for another video. As always, I'm a CPA and not a financial advisor, so please do not take this as financial advice. And before we begin, let me thank today's video sponsor, which is the Motley Fool. The Motley Fool has a ton of great resources and products available for investors of all different levels. And right now, if you go to fool.com/Mark, you could sign up to receive their 10 best stocks to buy right now. All right, let's get back to the video discussing a sector that I've covered for much of my investing journey. And let's begin by taking a look at our first REIT, which is VICI Properties, stock ticker VICI. And if you have followed me for any amount of time or you've joined our weekly live shows on Wednesdays, you know my appreciation and love for VICI Properties. There's a number of reasons, but the first reason is they own the best hospitality and casino properties across the world. Think about the ones they own just in Las Vegas. After all, they are the largest landlord on the Las Vegas Strip. Some of those assets include Caesars Palace, MGM Grand, Park MGM, Mandalay Bay, the Mirage, and coming soon, once they tear down the Mirage, a brand new state-of-the-art Hard Rock Casino. And this is just touching the surface. VICI has a market cap of $32 billion, and over the past 5 years, shares are up 40%. During the pandemic, shares dropped as low as $10 per share. So from there, shares have 3x'd. I love this stock for a number of reasons. I already alluded to the great assets, but they also have a great management team, growing free cash flows, which lead to growing dividends. In the past month, shares of VICI are up 10%, but again, I believe this is just the beginning. Before we take a look at valuation, let's take a look at that juicy dividend. This is a company that has been dedicated to growing their dividend from the start. They pay a dividend of $1.66 per share, which equates to a dividend yield of 5.4%. Just a few weeks back, that was closer to 6%. They have a 5-year dividend growth rate of 7.6%. On top of that fantastic dividend, this is a stock that trades at a cheap valuation. Analysts are looking for the company to generate a FFO in 2025 of $2.33 per share, which equates to a forward price to AFFO of just 13.1 times, well below the company's 5-year average of 16.3 times. And I believe that that 5-year average is quite low in itself. So there is a ton of upside when it comes to VICI Properties. Let's take a look at the second REIT on our list, which is Alexandria Real Estate, stock ticker ARE. Alexandria Real Estate, although it is a office REIT, it is not your typical office REIT. This is a company that owns properties that are leased out to life science type companies, a lot of healthcare, where a lot of research is being done. The company has more than 800 plus tenants in the fields of multinational pharma, biotech, and life sciences. The company has a market cap of $23 billion, and over the past 5 years, shares are down 12%. With all of those losses coming post-rate hikes. And in fact, shares have been as low as $90 per share. This is a company that has been very misunderstood for a number of years, but investors are starting to take notice. We alluded to where the stock price was, and you can see where it is now. And I only believe it is going to go higher from these levels. This is a company that doesn't have issues with fundamentals. It has a stock price issue right now. Again, although the stock price has been low, the company fundamentals continue to be very solid and demand even better, with occupancy levels remaining in the mid to high 90 percentile. The tenants they lease space out to are not just your ordinary Joe companies. They are high quality, investment grade tenants. In fact, in Q1, 92% of the company's top 20 tenants were investment grade. Companies that have their ability to grow their dividend year in and year out also have the ability, or must in fact have the ability, to also grow their free cash flow, which is something Alexandria has been able to do. Hence the 13 consecutive years of dividend growth this company has paid out. The company currently pays a dividend of $5.20 per share, which equates to a dividend yield of 4%. And they've been growing their dividend at a 5-year dividend growth rate of about 5.5%. On top of that fantastic dividend, this is again a stock that trades at a cheap valuation, an extremely cheap valuation. Analysts are looking for the company to generate 2025 AFFO of $7.80 per share. That equates to a forward price to AFFO multiple of 16.2 times, well below, and I mean well below, their 5-year average of 27.3 times. We want to go even further out. Over the past decade, investors have been willing to pay 24 times for this company. Again, right now, closer to 16 times. There's plenty of value to be had in Alexandria. And that leads us to REIT number 3, which is Realty Income, stock ticker O. Let's end with the gold standard when it comes to the REIT sector. There's not too many other companies out there that have been more consistent than Realty Income over the years, looking at company fundamentals. After all, they're also known as the monthly dividend company. Realty Income is a net lease retail REIT, meaning a lot of their typical landlord costs are passed on to the tenants. Think of things like property taxes, passed on to the tenants, common area maintenance, passed on to the tenants, insurance costs, passed on to the tenants as well. Realty Income is the largest company on our list today with a market cap of $50 billion, but they're also the worst performing. Over the past 5 years, shares are down 15%. But that's how we find opportunities. During the pandemic, shares dropped to around $40, not too far off where the stock was back in October of 2023. When it comes to investing, we're constantly looking for high-quality companies trading at low valuations. After all, we want to buy low and sell high. But when you see a stock price falter like it has with Realty Income or many of these REITs, you sometimes want to question, well, is there something fundamentally wrong with the business? Well, let's take a look. When we look at occupancy, it's above the historic median for the company, which is well above the historic median for the REIT sector. Right now, it sits at 98.6%, nearly fully occupied. Okay, so it's not occupancy. What about AFFO growth? Well, when we look at that, we see a company that has not seen negative year-over-year AFFO growth since 2009. And the CAGR has not really moved much since 2013. This is the ideal situation for an investor. A cheap value and fundamentals that remain strong and haven't altered all that much. The company has a fantastic portfolio of properties that are leased out to investment-grade tenants. All of this generating higher and higher amounts of free cash flow. After all, Realty Income is only one of 3 REITs that are on the Dividend Aristocrat list. Speaking of that dividend, the company currently pays a dividend of $3.16 per share, which equates to a dividend yield of 5.5%. And they've been growing their dividend at a 5-year dividend growth rate of 4%. And I might add, this dividend is paid out every single month. On top of that fantastic monthly dividend, this is a stock that also trades quite cheap. Analysts are looking for the company to generate 2025 AFFO of $4.33 per share, which equates to a forward price to AFFO of 13.3 times, well below the company's 5-year average of 18.2 times. A high-quality REIT, one of the highest, trading at a fantastic valuation. So there we just looked at 3 high-quality REITs, all REITs that are within my portfolio. And when you look back over the next 12 to 24 months, you're going to fill in the blank and say, I wish I bought more of that particular REIT, because rates are coming down and REITs are getting ready to soar once again. Down in the comments section below, let me know which is your favorite REIT on the list today. And if it's not one of these 3, fill out what is your favorite REIT moving forward. And if you haven't done so, make sure you show your appreciation by clicking that like button. I truly appreciate it, and we'll see you in the next one. Take care.